So if you bought the property with a 5-year loan, right, in 1920, that's coming due or has come due, right? And you need to transact. You either need to sell or refinance. Start with what's let's start with what's not transacting, and then we'll flip to what is. So if you owned your property and it was stabilized between the period of 2019 and 2022, and you wanted to hold the property, you likely refinanced, right? There was just a refinancing boom. We were doing hundreds and hundreds of millions of dollars of loans, right? And most of those loans were 5, 7, 10, 12 years of term. So the legacy type properties, I'd call it, that intended to be held for a while were refinanced, and those are not likely electing to be refinanced. Okay, so that's what's not transacting. What is transacting is the stuff that was acquired in that timeline from 2019 to 2022, because now the business plan has gone through, they put the business plan in motion, it's been executed, and value has been created, or there is some looming maturity event, right? So if you bought the property with a 5-year loan, right, in 1920, that's coming due or has come due, right? And you need to transact. You either need to sell or refinance. So even though you may have gotten that cheaper rate, right, a 4% rate 5 years ago, well, you have a balloon. So you have some event, and you need to transact. Alternatively, the stuff that was bought in 2021 and the first half of 2022, most of that stuff was on shorter duration loans, right? 3 to 5 year loans, and those are maturing. And the business plan hopefully has been executed, and enough value has been created where you can refinance the outstanding first mortgage balance, maybe recoup some equity. If not, a lot of that stuff is what's selling, and that's what's transacting on the acquisition side. Every one of those loans, you could borrow up to 75%, depending on price, right, or value. But if the cap rates are very low, right, and interest rates are similar, the lower the cap rate, the less leverage you can get. It's the same thing, same phenomenon that goes on in California versus Ohio, right? And what is the reason for all of that? The reason is rent growth, right? So why am I going to go and pay up for a core apartment building or a core storage facility in a supply constrained market? It's because I think that that there's going to be a ton of rent growth, right? So you may go pay up for good real estate, thinking that 3, 5, 10 years from now, you're going to have a lot of rent growth that's going to push up your yield on cost. Look, so the question really is, how are cap rates in the same quality of assets across property types, right? Multi is pretty low, industrial is pretty low, storage is also pretty low, less so than retail, less so than office, right? Far less so than hotel, right? Think of the how would you say, like, the expertise required to operate a property is kind of what drives a lot of that risk, right? So a hotel is effectively a business, right? So the cap rate might be 10, 11%. An office building has tons of lease roll, right? And commissions and expertise to lease that. So that requires a little bit higher cap rate. Retail, a lot of tenants, take some expertise to lease that, little bit higher cap rate. Industrial might just be 1 or 2 tenants, right? A lot of tenants, less supply. So you're going to get a lower cap rate. Same thing with apartments, right? You lose 1 tenant, it doesn't drive your cash flow down, so there's a little bit less risk. So tighter cap rate, same thing with storage, right? So we just kind of think about it from that perspective. So what you're seeing a lot of is high net worth guys, single check in that kind of private client space, where that's who your buyer is. Well-capitalized groups, experienced groups, long-time investors, or just well-capitalized. And then, you're seeing a ton of institutions looking to scoop up the bigger stuff that's trading below replacement cost, maybe a problem, maybe the deal's in lease up, it's not, maybe construction costs went up or their construction loan didn't have a cap or a swap and ate them up a little bit. So yeah, you're seeing on the private client side mostly like well capitalized, experienced sponsors, and then in the institutional stuff, like institutions are ready to go for the discounted stuff.